Money, while essential for daily life, does not always retain its value over time. This phenomenon, known as the loss of purchasing power, means that the same amount of money can buy fewer goods and services as years go by. Understanding why money loses value is crucial for everyone, as it affects savings, investments, and financial planning. Factors such as inflation and changes in the economy contribute to this gradual decline. By grasping these concepts, individuals can make more informed decisions to protect and grow their wealth. Inflation is the rate at which the general level of prices for goods and services rises over time. As prices increase, each unit of currency buys fewer goods and services, which means the purchasing power of money declines. This process can be influenced by factors such as increased demand, rising production costs, or expansion of the money supply. Central banks and governments closely monitor inflation because it affects the cost of living and the overall health of the economy. Understanding inflation helps explain why the same amount of money may not go as far in the future as it does today. Throughout history, inflation has played a significant role in shaping economies and the lives of individuals. One notable example is the hyperinflation experienced in Germany during the early 1920s, where the value of the currency plummeted and basic goods became unaffordable for many citizens. Similarly, in Zimbabwe in the late 2000s, runaway inflation led to the collapse of savings and widespread economic hardship. These episodes demonstrate how inflation can erode purchasing power, disrupt financial stability, and force governments to take drastic measures. By examining these historical cases, we gain insight into the profound effects that inflation can have on both national economies and everyday life. Inflation is influenced by a variety of factors, each playing a significant role in shaping the overall economic landscape. Government policies, such as changes in interest rates or fiscal spending, can directly impact the level of inflation within a country. Supply and demand dynamics also contribute, as shortages or surpluses of goods and services affect prices. Additionally, global events like geopolitical tensions or disruptions in international trade can lead to fluctuations in costs, further driving inflation. Understanding these interconnected elements helps explain why inflation rates can vary over time and across regions. Inflation gradually erodes the purchasing power of money, meaning that the same amount of cash buys less over time. For savers, this can diminish the real value of their bank balances, as interest earned may not keep pace with rising prices. Investors may see their returns affected, especially if their assets do not grow faster than inflation. Everyday expenses, such as groceries, transportation, and housing, tend to increase, making it more challenging for households to maintain their standard of living. In practical terms, inflation highlights the importance of planning and adjusting financial strategies to preserve wealth. To safeguard against the negative impacts of inflation, individuals often diversify their investments, choosing assets like stocks, real estate, or commodities that tend to retain value over time. Businesses may adjust their pricing strategies, renegotiate supplier contracts, or seek efficiencies to offset rising costs. Both groups can benefit from monitoring economic trends and planning budgets that account for potential price increases. Additionally, maintaining cash reserves and exploring inflation-protected securities can provide extra financial stability. These proactive measures help reduce vulnerability and ensure greater resilience in an unpredictable economic environment. In summary, money tends to lose value over time due to factors like inflation and changes in economic conditions. This gradual decline in purchasing power can impact savings and long-term financial planning. Understanding these dynamics is essential for making informed decisions about investments and expenditures. By staying updated on financial trends and economic indicators, individuals can better protect their assets and adapt to changing circumstances. Remaining informed empowers people to navigate the complexities of the financial world with greater confidence. Thank you for joining us for this presentation. We appreciate your time and interest in the content we've shared. Your engagement helps us continue to provide informative and enjoyable material. We look forward to sharing more with you in the future.